You know, usually when we talk about a business failing, we expect some sort of visible dramatic catastrophe, like, I don't know, an engineering failure where the servers literally catch fire.
Right. Or, you launch this highly anticipated product and there are just absolute crickets from the market.
Exactly. The revenue chart just tanks, and everyone in the industry points at it and says, well, there it is, bad product market fit.
Yeah. And it's comforting in a strange way when a business fails loudly like that.
Comforting.
Yeah, I mean, we want failure to be clean. We like it when things can be neatly categorized by macroeconomic forces or, sudden shifts in consumer behavior. It just makes the world feel predictable.
But then you step into the actual day-to-day reality of small business operations,
Mm.
specifically the regulatory frameworks they operate under, and suddenly that clean, predictable narrative just completely shatters.
It really does. It shatters completely.
Because we are looking at a landscape today that is defined by, well, an invisible drain. And I want you, the listener, to really put yourself in the shoes of a resource-constrained founder for a minute here.
Yeah, just imagine that morning routine.
Right. Imagine waking up, pouring your morning coffee, opening your laptop to check your business bank balance, and realizing a massive, agonizing chunk of your hard-earned profit has silently vanished overnight.
And, critically, not because your sales team underperformed.
No, not because a rival company outmarketed you with some, like, better ad campaign either.
No. Simply because of a missed regulatory filing you didn't even know existed.
Exactly. Welcome to the invisible compliance tax.
It is the absolute definition of a structural bottleneck.
Yeah.
I mean, it's the kind of grinding administrative friction that, well, it never makes the front page of TechCrunch, right?
Or the Wall Street Journal.
Right. But it quietly, mercilessly dictates who survives the first 5 years and who just gets crushed.
And that silent crushing is exactly what we're tearing apart in our deep dive today. And we have an incredibly dense, fascinating stack of sources to guide us through this.
A really heavy stack this time.
Yeah, we are pulling from an incisive Times of India report that actually quantifies the sheer regulatory burden on MSMEs. So that's micro, small, and medium enterprises.
Which is the backbone of the economy.
Absolutely. We also have a series of deep dive strategic blueprints focusing on founder-grade content and systems thinking.
And those blueprints, they provide a very unique, almost architectural lens on how to view these bottlenecks.
Yeah, it's not just complaining about the problem. And then on the academic side, we are looking at a 2026 Zenodo study on SME profitability drivers.
That one is packed with hard data.
It is. And finally, some very heavy legal analyses regarding India's new Digital Personal Data Protection Act, or the DPDP Act.
What stands out to me when looking at this stack is the convergence.
I so.
Well, you have a mainstream news investigation, right? And then a highly quantitative academic profitability study, plus a dense legal breakdown and an operational startup blueprint.
They are speaking completely different languages.
Exactly. Yet they all point to the exact same hidden crisis.
So our mission today is to view this compliance crisis strictly through the eyes of that resource-constrained founder. We want to find the exact breaking point where these seemingly mundane regulations stop being just a standard cost of doing business and start actively suffocating growth.
But we aren't going to spend this entire time just, admiring the problem.
No, definitely not. We're going to use these sources to map out a structural solution. We want to figure out how a savvy operator can turn this massive, bleeding operational headache into a proprietary competitive moat.
Because the companies that actually solve this underlying infrastructure problem, they are going to do much more than just save a founder some time.
What's the bigger play?
They are positioning themselves to capture the single most valuable data set in the entire commercial ecosystem.
We will absolutely get to that ultimate moat. But before we can talk about solutions, we need to confront the staggering, almost unbelievable math of what a founder is up against on a random Tuesday.
The math is brutal.
The Times of India report data is frankly mind-blowing. Let's ground this in reality. Imagine a typical manufacturing MSME. Maybe they make custom auto parts or textiles operating in just a single state in India.
Keeping it localized.
Right. According to the report, that one small business faces an overwhelming 1,450 regulatory obligations a year.
Wow.
Yeah, spread across 7 different categories of law.
Let's just pause and let that number settle. 1,450 separate obligations.
It's absurd.
If you do the basic arithmetic on that, we are talking about roughly 4 distinct, legally mandated regulatory actions that must be taken every single day of the year.
Every single day.
Yeah. That includes weekends, that includes national holidays. Every single day, 4 things must be filed, updated, or reported.
And it gets so much more granular than just, hitting submit on a web portal. To handle those 1,450 obligations, the report highlights that these founders are required to manage 48 different registers.
Okay, for anyone who hasn't worked on a factory floor or in a traditional back office, we should really clarify what a register actually means in this context.
Yeah, please do. Because it sounds like just a notebook.
Right, it is not just a casual checklist on a whiteboard in the break room. A register is a formalized, legally mandated, often physically bound record of specific operational activities.
Physically bound, like a literal book.
Often, yes. You have a register for daily employee attendance, a completely separate register for wage disbursement,
So that's 2 already.
another for safety equipment inspections, another for the physical movement of raw materials in and out of the loading dock. I mean, each one of these 48 registers requires strict, constant upkeep.
And I'm assuming in very specific formats.
Exactly. Formats dictated by local labor or tax laws. If you use the wrong column header, you're technically non-compliant.
Unbelievable. And then, as if maintaining a small library of physical ledgers wasn't enough, there are the physical inspections.
Oh, the inspectors.
Yeah, the data notes that an MSME can face 59 different types of inspectors.
59?
59. I'm trying to wrap my head around that. Just managing the calendar to accommodate 59 potential, often unannounced inspector visits sounds like a full-time job for a dedicated manager.
It absolutely is a full-time job. But here's the critical disconnect. These are resource-constrained startups.
Right.
We are talking about teams operating on razor-thin margins and extremely lean budgets.
Yeah.
They do not have a dedicated compliance department sitting on the 4th floor.
They don't even have a 4th floor.
Exactly. Operationally, what this looks like is a massive scramble. They are not using sophisticated automated enterprise software. The reality is far messier.
So what are they using?
They are juggling a local overworked accountant, a dozen fragmented Excel sheets, maybe a couple of disconnected billing apps on a smartphone, and literally a stack of paper folders.
And what does it actually cost to hold this fragile web of paperwork together? Because the Times of India report pins the direct financial cost of compliance between 13 to 17 lakh annually.
Yeah, 13 to 17 lakh, just to stay out of trouble.
And that is just to keep the doors legally open. I mean, that is money spent before the founder has invested a single rupee into research development, hiring better talent, or marketing their actual product.
Which brings us to a foundational concept highlighted in the strategic blueprints from our sources. They describe the current state of SME operations as relying on memory as an operating system.
Memory as an operating system, that sounds incredibly fragile.
Think deeply about how fragile that is. When a business relies on a local accountant, a spreadsheet saved on someone's desktop, and an assortment of fragmented apps, there is zero systemic integration.
Right, they don't talk to each other.
Not at all. So the entire burden of staying out of legal trouble, remembering when the GST filing is due, knowing which of the 48 registers needs an update today, anticipating which of the 59 inspectors might walk through the door, it all depends entirely on human memory.
It depends on a founder remembering to text their accountant at 8 p.m. on a Friday.
Yes.
Or an accountant remembering to set a calendar alert on their personal phone. I mean, it is an entire business infrastructure built on digital sticky notes and sheer exhausting willpower.
And human memory is incredibly fallible, especially under immense cognitive load.
Obviously.
The core principle the sources emphasize over and over is simple. Memory does not scale.
Memory does not scale.
No. When you attempt to build a growing business on a memory-based operating system, under the crushing pressure of 1,450 recurring obligations, failure isn't just a possibility. It is a mathematical certainty.
Because humans forget.
Humans forget. Spreadsheets get corrupted. An accountant goes on vacation or gets sick.
You know, I was trying to think of an analogy for this while reading the notes.
Ooh. What did you come up with?
Well, running a startup in this environment feels a bit like trying to win a Formula One race.
Okay, I like that.
You've got the car, you've got the drive, you want to go fast, but you are legally required to pull over on every single lap.
Oh, man.
Yeah. You have to get out of the car, fill out paperwork in triplicate, get it physically stamped by 3 different track officials, and make sure your pit crew is simultaneously updating 48 different clipboards before you can hit the gas again.
That sounds agonizing.
It is. How does a small firm even dream of reaching scale when that much of their forward velocity is bled out by bureaucratic pit stops?
It is a highly restrictive environment that actively punishes speed. I mean, your Formula One analogy captures the friction perfectly, But based on the data, we actually need to add a much more chaotic layer to it.
More chaotic than stopping every lap.
Oh, yeah. The sheer volume of the paperwork and the frequency of the pit stops is devastating on its own.
Yeah.
But what happens when the governing body of the race decides to change the rule book while you are actively driving at 200 miles an hour?
Wait, how fast are the rules actually changing?
The Times of India report paints a picture of an intensely dynamic, almost volatile regulatory environment. We're looking at an average of 42 legal updates per day.
42 updates every single day.
Yes, every single day. If we look at the 2024 to 2025 financial year alone, there were 9,331 regulatory changes across various ministries, departments, and local authorities.
That is not a regulatory environment. That is a regulatory tsunami.
It really is.
How on earth is a three-person manufacturing company supposed to track, interpret, and implement 42 legal changes a day? Do they even get notified?
Well, usually they don't get a neat personalized notification in their inbox. They find out through the grapevine, or when their accountant frantically calls them, or worse, when an inspector hands them a penalty notice.
That's terrifying.
This is where we have to critically examine the structural asymmetry in the market, because the report states a crucial, devastating fact. 90% of these 9,331 changes directly impact MSMEs.
Wait, 90%. So the people with the absolute fewest resources, the ones operating with basically no safety net, are getting hit with the vast majority of the rule changes.
That is the reality.
Oh.
If we zoom out and connect this to the broader economic picture, we have to look at how these frequent regulatory updates disproportionately burden small operations versus large established incumbents.
The big guys.
Right. Let's compare our resource-constrained founder to a massive legacy corporation. When 42 new legal updates drop on a random Tuesday, how does the corporation react?
For them, it's probably just a line item in a massive corporate budget. They absorb it.
Precisely. They absorb it. They have an entire floor dedicated to in-house legal counsel.
Yeah, armies of lawyers.
They employ compliance officers whose singular job description is to read those updates, interpret them, and draft internal memos. They use multi-million-dollar enterprise software that automatically patches the new tax rules into their global ERP systems overnight.
So they don't even feel it.
The large incumbent absorbs the shock of 42 daily changes without the CEO even blinking.
But for the founder.
For the founder, those 42 changes represent pure chaos. They have their local accountant who is likely drowning in work managing 50 other small business clients simultaneously.
Right.
The founder doesn't have a legal team to interpret the nuances of a new labor code. The founder is the legal team, usually sitting at their kitchen table at 2 a.m. after they finish handling customer support, inventory, and payroll.
That is a brutal competitive asymmetry. I mean, it means the big players are essentially playing a different game on a completely different field.
And this brings up a very sharp founder-grade question posed in the strategic blueprints. When we look at a system this complex, this fragmented, and this constantly shifting, we have to ask, who actually benefits from this obscurity?
Well, because it certainly isn't the founder. The founder is losing sleep and profit. So who wins when the rules change 42 times a day?
The blueprints outline this ecosystem very clearly. Legacy accounting firms, massive compliance shops that bill by the hour, and fragmented SaaS vendors who sell partial Band-Aid solutions, they all benefit immensely from the complexity. The opacity of the system is the protective moat around their business models.
Okay, let's unpack this. I see the mechanics of that. If the rules were impossibly complex but static, like they never changed, you could eventually learn them.
You figure it out eventually, yeah.
But because they are constantly changing, the founder remains perpetually off balance.
Exactly.
They become completely dependent on manual interpretation by outside experts. They are forced to pay the hourly rate just to have someone translate the chaos into basic instructions.
The complexity actively creates a dependency loop. I mean, think about it. If compliance was simple, automatic, and transparent, the lucrative industry of hourly billable translation work would evaporate overnight.
Right, they'd be out of a job.
So there is an entire entrenched ecosystem of service providers whose quarterly revenue relies heavily on the system remaining fragmented, intimidating, and really hard to understand.
But wait a minute. If 90% of these changes hit the smallest businesses, and there are millions of MSMEs out there driving the economy, isn't the system actively penalizing early-stage growth?
It definitely is.
It feels like obscurity is essentially acting as a protective shield for the big players. The massive incumbents don't have to worry about the scrappy, innovative startup disrupting them because The scrappy startup is drowning in 48 physical registers and paying 17 lakh a year just to stand still.
That is a profound realization, and it is exactly what the macroeconomic data suggests. The sheer burden of this friction restricts formalization.
It keeps them in the shadows.
Yeah, it limits employment growth because hiring triggers more compliance, and it fundamentally stifles innovation. The big players remain protected at the top of the food chain, not necessarily because they have a superior product or better customer service,
But because of paperwork.
because the entry fee to meaningfully compete is surviving a regulatory maze that heavily favors massive administrative budgets.
So let's bring this back down to the ground level, back to our resource-constrained founder.
Let's do it.
They are trying to innovate. They are already bleeding 17 lakh a year just to manage the basics. Their memory-based system is cracking under the weight of 1,450 rules, and the playbook is changing 42 times a day.
A recipe for disaster.
Right. So what actually happens when they inevitably slip up? Because in an environment that chaotic, making a mistake isn't a probability, it is an absolute guarantee.
This is where we cross into what the sources define as the breaking point. To understand the psychology of the founder, we have to contrast the steep cost of staying compliant with the severe, often existential risks of failure.
Okay, walk me through the risks.
We already established the 17 lakh baseline cost of adherence. But let's look at the punitive side of the ledger. Let's look at what the sources call the GST trap.
GST being the goods and services tax, the primary indirect tax mechanism in India. What makes it a trap?
The notes detail how the penalty structure is designed. Late GST filings attract daily late fees. Depending on the specific forms and the turnover of the business, this can range from 50 to 200 euro every single day the filing is delayed.
I mean, 50 euro a day might sound like pocket change to a massive corporation. But for a micro enterprise managing cash flow week to week, that is a constant annoying drip that eats into their margin.
It is a drip, but it compounds viciously. On top of the daily flat fees, there is an 18% interest rate applied to the unpaid tax amount.
18%.
And it gets worse. Depending on whether the tax authorities determine the failure to file was intentional or just a clerical error, penalties can range from 10% to 100% of the tax owed.
Wait, a 100% penalty. Are you saying a business could owe double their original tax burden just because their accountant got sick, their memory-based system dropped a calendar invite, and they missed a deadline?
That is exactly what happens.
That's insane.
And the guides from tax advisors included in our sources show how these recurring late fees and high-interest penalties quietly, steadily erode MSME cash flow. But believe it or not, the most damaging part of the GST trap isn't even the direct fees.
How could it be worse than double the tax?
It is the blockage of the input tax credit, or ITC.
Okay, explain the ITC blockage, because that sounds like a critical mechanism.
The input tax credit is essentially how a business avoids paying tax on tax.
Right.
If you buy raw steel to make your auto parts, you pay GST on that steel. When you sell the finished auto part, you collect GST.
That makes sense.
The ITC allows you to subtract the tax you already paid on the raw steel from the tax you owe on the final sale. It is vital for working capital.
It keeps the cash moving.
Exactly. But if you or even your suppliers are non-compliant or late with filings, that credit is blocked. The government effectively holds your money hostage.
That is brutal. It is a financial friction that grinds the gears of the entire supply chain to a halt. You are punished not just for your own memory failures, but for the memory failures of the people you buy from.
Yep. And yet, the financial penalties, as severe as they are, represent only one half of the breaking point.
Only half.
The other half is far more intimidating. It is what the sources refer to as the criminalization of compliance.
Criminalization. We are talking about administrative paperwork here.
We are, but a comprehensive Team Lease RegTech report identified 486 specific imprisonment clauses buried within these MSME regulations.
Imprisonment, you can actually go to jail for a regulatory slip-up.
Yes. And significantly, the report notes that labor laws contribute to 66% of all imprisonment-related clauses.
So mostly HR stuff.
Basically. This means that minor missteps, procedural violations in how a specific attendance register is formatted, or how a localized labor update was filed, carry severe legal risks.
That's terrifying.
The founder isn't just risking their profit margin or their business's survival. They're literally risking their personal freedom.
I am trying to visualize the psychological weight of that. Imagine you are a founder, things are finally going well, and you want to hire your 10th employee. You want to grow, you want to create local jobs.
A great milestone.
Right. But sitting in the back of your mind is the terrifying knowledge that messing up the paperwork related to this new hire, maybe misinterpreting one of the 42 daily updates, could trigger one of 486 imprisonment clauses. The anxiety must be paralyzing.
It creates a massive chilling effect on expansion.
Yeah.
Founders second-guess every move, and that existing psychological toll is now being dramatically amplified by a completely new legislative threat outlined in the sources.
Which
The DPDP Act, the Digital Personal Data Protection Act of 2023.
Okay, I followed the global privacy trends. Europe went through a massive upheaval with GDPR a few years ago, and California has CCPA. How is the DPDP Act specifically impacting Indian MSMEs?
Well, the legal analysis in our SAC is unequivocal on this point. The Act applies broadly to all entities processing digital personal data within the country.
Okay, standard so far.
But the critical, terrifying detail for founders is this. There are no automatic exemptions for small and medium enterprises.
None at all. So a 3-person health tech startup trying to build a basic symptom tracker is held to the exact same foundational privacy standards as a multinational tech conglomerate.
In terms of the core legal obligations, yes.
That seems impossible.
They must implement robust, verifiable consent systems. They have to provide highly detailed notices before collecting a single byte of data.
Right.
They must ensure stringent security safeguards and establish formal grievance redressal mechanisms for users. They have to map where every piece of data lives, who touches it, and when it is deleted.
I mean, that is an enterprise-level IT operation.
It really is.
And if this 3-person startup fails to do that, if a database is misconfigured or a consent log is lost, what does the penalty regime look like under the DPDP Act?
The Act empowers the newly formed Data Protection Board to impose penalties of up to 250 crore per breach.
I need to make sure I heard that correctly. 250 crore.
Yes.
That is roughly 30 million US dollars. For a single data breach. That is not a fine. That is an extinction-level event.
It makes even modest technical lapses entirely existential for small firms. And the legal analysis argues a very nuanced point here.
What's that?
While the Act is normatively highly desirable, I mean, we all want our privacy protected and data secured, right?
Well, of course.
But unless highly calibrated, automated compliance mechanisms are developed specifically for smaller players, it risks completely stifling grassroots digital innovation. A founder simply cannot risk a $30 million penalty while they're just trying to find product market fit.
So we have mapped out the entire threat surface here. We have the 17-lag baseline cost, the 42 daily updates, the daily late fees, the 18% interest trap, the blocked tax credits, the 486 imprisonment clauses, and now a looming potential 250 crore data privacy fine.
It's a bleak picture.
It is. How does this overwhelming friction actually translate to the bottom line? Do we have hard data on the breaking point where this regulatory burden officially outweighs the potential for a business to grow?
We do. And this is where the 2026 Zenodo study is incredibly illuminating.
Tell me about it.
The researchers conducted a rigorous analysis of 380 GST-registered SMEs specifically to isolate profitability drivers. They analyze everything from supply chain costs to marketing spend.
Trying to find out what hurts profits the most.
Exactly. And they found that the GST compliance cost burden is the dominant negative predictor of the net profit ratio.
The dominant negative predictor, meaning of all the complex market forces that can hurt a small business's profits, bad marketing, expensive supplies, whatever, the pure administrative cost of just doing the compliance paperwork is the biggest single drag on their bottom line.
Yes, it beat out everything else. The study provides the statistical proof for what founders have felt intuitively for years.
Wow.
Now, the paper uses a lot of academic jargon. They cite a beta coefficient of approximately negative 0.421 with a p-value of less than 0.001.
Okay, getting technical.
They also highlight a strong negative correlation, an R value of roughly negative 0.87 between compliance cost and net profit margin.
Okay, for those of us who haven't sat in a statistics class recently, can you translate those coefficients into plain English? What does an R value of negative 0.87 actually mean for a founder staring at their monthly ledger?
It means the relationship is incredibly strong and inversely related. In simple, practical terms, as the cost and time burden of compliance goes up, the net profit margin goes down almost in perfect lockstep.
Like a seesaw.
Exactly. The statistics prove that compliance drag is not just an annoying back-office complaint. It is not just the quote-unquote cost of doing business. It is mathematically dictating the survival and profitability of the enterprise.
So it's actively killing them.
Yes. The sources describe it perfectly. It is a steady financial leak. It is a slow, quiet bleed of essential capital.
So the founder is trapped in an impossible dilemma. You either bleed your precious capital to stay compliant by paying the 17 lakh to the hourly consultants just to tread water,
Right.
or you try to manage it yourself, rely on your memory, inevitably fail, and risk a 250 core fine, an 18% interest rate trap, and literal jail time. It is like being forced to choose between a slow leak that empties your swimming pool over a year or a massive tidal wave that destroys your whole house instantly.
It is an environment where the mere act of execution is heavily penalized. And the strategic notes emphasize a critical perspective gap here.
What kind of gap?
Well, from the outside to a policymaker in a capital city or an executive at a large corporation, this just looks like admin pain. It looks like an annoyance. But to the resource-constrained founder on the ground, it is a hidden, punitive tax on execution itself.
Given how massive, painful, and expensive this problem is, I have to ask, what is the tech industry doing about it? Because usually when there is a multi-billion-dollar friction point, the software world swoops in with an army of developers to solve it. Are the SaaS tools that founders are currently buying actually fixing this leak?
That question leads us to a fascinating and highly critical analysis within the founder-grade content blueprint.
Oh.
The sources argue forcefully that current technological solutions in the market are acting as false prophets of productivity.
False prophets. That is a heavy accusation. Why are they failing?
Because the market is currently flooded with shallow tools. Slick billing software, natural language reminder apps, and incredibly complex visual dashboards.
Right, I've seen a million ads for those.
We all have. These solutions are looking at the business and addressing only the visible symptoms. A developer builds a tool to remind a founder about an upcoming GST filing, or creates a digital checklist for e-invoicing, or offers a template repository for DPDT readiness.
On the surface, that sounds helpful. I mean, a reminder is better than forgetting.
It sounds helpful, but it completely fails to address the actual structural bottleneck. Let's dismantle why these solutions fail in practice.
Let's do it.
A reminder app ringing on your phone at 4 p.m. does not solve the underlying agonizing work of data reconciliation. It just tells you that you are behind.
Right. Now you're just stressed and behind.
Exactly. An executive dashboard showing a grid of red and green lights does not solve the problem of who actually owns the execution of the task. A red light just induces panic. It doesn't do the filing.
And as we discussed earlier, leaning harder on your accountant isn't a systemic fix either.
No.
Because an accountant does not miraculously become a scalable software system just because the business relies on them like one. They are still a human being, subject to the exact same memory constraints, cognitive fatigue, and the impossible task of tracking 42 daily legal updates.
Exactly. The human remains the bottleneck. And the blueprints are particularly critical of how artificial intelligence is currently being aggressively marketed and misused in this space.
Yes, I wanted to bring that up. Everyone wants to slap an AI label on their product right now. How is artificial intelligence falling short here? Surely a large language model can read those 42 legal updates faster than a human.
It can read them, but reading is not executing. The blueprints explicitly state a core operational reality that tech founders often ignore. Automation moves bottlenecks, it does not erase them.
That's a great quote.
And they add a crucial quotable warning. Prompts without product depth do not matter.
Prompts without product depth do not matter. I want to linger on that. What does that actually look like in practice?
It means that a shiny new AI chatbot that uses perfect natural language to remind you to file your taxes, or an AI that beautifully summarizes the latest 42 regulatory changes into a neat, bulleted email. It doesn't actually fix the underlying fragmentation of your business data.
It's just a smarter messenger.
Exactly. If the AI doesn't have deep, integrated write access to the actual operational mechanics of the business, the ledger, the bank, the portal, it is essentially just a highly articulate, very expensive alarm clock.
It tells you the house is on fire with great eloquence, but it doesn't hold a hose.
That's a perfect way to put it.
So if reminders, color-coded dashboards, and articulate AI alarm clocks are just superficial band-aids on a severed artery, what is the actual surgery required here? What is the fundamental shift in architecture we are missing?
The answer is not another app that sits on a smartphone. The answer, according to the deep dive strategic analysis in our stack, is a completely different layer of underlying infrastructure. It is what the blueprints refer to as building the compliance rail.
The compliance rail. Okay, I am intrigued. How does a startup actually build this? How do you turn this absolute nightmare of fragmented regulatory compliance into a seamless competitive control point? What physically is this rail?
To understand the rail, we have to look back at the fragmented, chaotic reality we discussed earlier. The surgery required is building a deep infrastructural orchestration layer.
Orchestration layer, right.
It is a system that creates a continuous, automated connection between four distinct pillars of a business that currently do not speak to each other in almost any SME.
Let's break down those four pillars. What is the foundation? What is pillar one?
The first pillar is the bank accounts. This is the absolute ground truth of the business.
Because it's the actual cash.
Right. It is where the actual money moves, where invoices are settled, and where the reality of cash flow exists in real time.
And pillar two?
Pillar two is the GSTN, or the Goods and Services Tax Network. This is the government's massive digital portal where tax liabilities, input credits, and e-invoices are officially legally recorded.
So we have the bank and we have the government portal. What is the third pillar?
The third pillar is the accounting ledgers.
Fast.
This is the SME's internal software, whether it's Tally, QuickBooks, or Zoho, where they categorize expenses, track their outstanding invoices, and manage their internal books.
Okay, got it. And the fourth, final pillar?
The fourth pillar is basic data protection hygiene. This means baking in foundational defaults that align strictly with the new DPDP Act we discussed.
So the privacy stuff.
Exactly. It involves automated consent management, secure data handling, and maintaining privacy by design right at the operational data entry level.
So if we look at the current memory-based system, these four pillars are completely isolated islands.
Utterly isolated.
The founder pulls a CSV file from their bank, emails it to their accountant. The accountant manually types those numbers into an accounting ledger, then manually logs into the government's GSTN portal to file the return, all while blindly hoping they aren't violating a data privacy rule regarding the customer's information. It is a terrifying game of manual telephone.
It is entirely manual, entirely reliant on human memory, and entirely prone to error.
So how does the rail fix it?
The compliance rail is designed to replace that manual game of telephone with deeply integrated automated orchestration. It builds digital pipes that connect the bank, the GSTN, the ledger, and the data hygiene protocols into a single, continuous, invisible flow.
But wait, I have to push back here.
Go ahead.
Conceptually, that sounds amazing, but practically, getting the Indian government's massive GSTN portal to seamlessly, reliably talk to a small startup's messy internal ledger and triggering that from a bank API, that sounds like an absolute nightmare of integration. Is that even technically feasible?
It is incredibly difficult to build, which is exactly why it is so valuable.
Fair point.
You have to build complex API wrappers and orchestration engines that can translate the messy reality of a bank feed into the rigid XML payloads required by the government portal.
That sounds like a lot of heavy lifting.
It is, but once it is built, it unlocks a transformative concept the sources call default compliance.
Default compliance. Walk me through the mechanics of that.
Default compliance means the system forces compliance to happen structurally as a byproduct of normal business operations, rather than relying on a human to remember to do it later.
Give me a real-world example.
Okay, let me give you an example of how the rail operates. You sell a piece of software for $100,000, the client pays you.
Awesome. Yeah.
The moment the $100,000 hits your bank account, the rail detects it via API. In milliseconds, the rail automatically pings your accounting ledger and reconciles the invoice, marking it paid.
So no manual entry.
None. It then reads the buyer's GST number attached to that invoice, calculates the exact 18% tax liability, segregates the $18,000 in your ledger, prepares the precise digital filing required, and pushes it directly to the government's GSTN portal.
Automatically.
Yes. Simultaneously, it logs the transaction data securely according to DPDP standards.
Ethics.
It does all of this invisibly before you have even refreshed your bank screen.
That is staggering. It completely removes the human from the loop of recurring data entry.
Completely.
But what happens to the human experts? What happens to the chartered accountants and the company secretaries? Are they just automated out of existence?
No, but their role fundamentally and necessarily changes. In the compliance rail model, human experts are elevated.
Elevated how?
They are kept in the loop strictly for edge cases. They handle the complex, nuanced strategic tax planning, the unusual cross-border transactions, or the audit defenses.
The stuff that actually requires a brain.
Exactly. They are finally utilized for their actual expertise, rather than being used as expensive, error-prone human data entry clerks for routine paperwork.
The strategic blueprint is a line that I loved. It emphasizes a core principle of systems thinking. The best technology doesn't start by trying to look visually impressive. It doesn't start with a flashy UI. It starts by making failure harder.
Making failure structurally harder.
Yeah.
That is the essence of the rail.
So instead of building a better, louder alarm clock to wake the founder up to do their taxes, which is what the false prophets are selling, we are essentially building an autopilot system that flies the plane while the founder sleeps.
Exactly.
The plane stays in the air, the recurring paperwork is handled, and failure like crashing into a 250-core data penalty or a 100% tax fine becomes mechanically, structurally almost impossible to do.
That is exactly the philosophical shift from a symptom-focused tool to a deep structural solution. But here is where the blueprints take a massive leap.
Oh, where did they go?
Saving the founder time, reducing their anxiety, and preventing penalties is incredibly valuable. But that is actually only phase one.
Phase one. What's phase two?
Phase two is where this concept shifts from being a highly helpful software tool into a massive, scalable, almost unassailable monopoly.
Okay, my ears are perking up. How does saving a small manufacturing firm from doing their GST paperwork turn into a monopoly?
This brings us to the ultimate moat. This is arguably the most powerful, paradigm-shifting concept in our entire stack of sources. The blueprints call it underwriting truth.
Underwriting truth. I need you to deeply explain the mechanics of that. How does an invisible compliance rail create a proprietary moat?
To understand the moat, you have to look at what the company building this rail is actually accumulating. They're not just selling a software subscription fee.
Right.
By embedding themselves deeply, by sitting at the exact infrastructural intersection of real-time bank movements, government tax filings, internal ledger quality, and data hygiene.
Yeah.
They are quietly capturing the most honest, unvarnished operating data set in the entire business stack.
Ah, I see where this is going.
You see it.
Yeah, because a founder can make a beautifully designed PowerPoint deck about their projected revenue growth. They can inflate their sales pipeline on a spreadsheet. But they absolutely cannot fake the hard, encrypted data flowing directly between their bank account and the government tax authority.
Exactly. A pitch deck is a story. The compliance rail is reality. If a platform sits on that rail, it sees the cleanest, most accurate operating picture of the business possible.
And how does having that clean data translate to what the sources call a massive asymmetric advantage?
Because that raw, transactional data reveals the true operational discipline and the exact risk profile of the business. It shows the platform precisely what gets filed on time.
Right, it tracks behavior.
It shows in real time where cash flow stress is beginning to materialize. Maybe a key client has started paying invoices 15 days slower this quarter.
They'd see that instantly.
Instantly. Crucially, because the rail handles the processes, the platform knows which compliance failures are deep systemic problems versus pure knowledge gaps. It is essentially a 247 high-resolution MRI of the business's operational health.
But why does that matter so much? Why is that MRI so valuable to own?
Because this underwriting truth becomes the foundational, unshakable layer for everything else a small business desperately needs to scale. Most importantly, it becomes the ultimate basis for creditworthiness.
Lending.
Yes. Think about how SME lending works today. A founder wants a loan to buy a new machine. They have to gather months of bank statements, audited financials, and tax returns, put them in a folder, and hand them to a human loan officer who spends weeks verifying the data, looking backward in time.
It's a slow, archaic process based on lagging indicators.
But if the business is running on the compliance rail, the platform doesn't need to ask for a shoebox of receipts. The platform can mathematically prove the exact financial stability, cash flow velocity, and compliance health of the business instantly.
Which means they can lend faster.
It paves the way for embedded finance. The software platform can offer highly customized, pre-approved lending directly within the interface, exactly when the founder needs it.
Because the platform already knows, with mathematical certainty, that the founder is good for the money. They see the cash flow trend lines before the founder's own accountant does.
It completely flips the lending model. Furthermore, this underwriting truth dictates supplier selection and enterprise onboarding.
How so?
Well, large multinational corporations want to integrate SMEs into their supply chains, but they are terrified of compliance liabilities.
Right, they don't want to get sued because their supplier messed up.
Exactly. The rail provides verifiable, machine-readable trust. The winner of this software market isn't going to be the company with the cleverest marketing campaign or the slickest UI. The winner is the company that successfully owns the default path through boring, recurring compliance work.
Because by owning that friction, they will control the infrastructure of trust for the entire MSME sector.
You've got it.
That is a profound realization. It is an absolute inversion of the problem. You take the absolute worst, most agonizing, most invisible part of a founder's life, the 4,450 rules, the 48 physical registers, the fear of jail time, you automate it silently into the background, and then you use the exhaust data from that automation to give them the lifeblood they desperately need. Instant loans, extended credit, and verifiable enterprise trust.
It transforms compliance from a pure bleeding cost center into a proprietary competitive advantage, both for the software builder who owns the rail and for the SME who operates on it.
I am completely sold on the architectural theory. It is brilliant. But the founder-grade blueprint in our sources is also highly pragmatic. It doesn't just theorize, it demands actionable validation.
Yes, you have to prove it.
It asks a very tough question. How would a serious resource-constrained operator test this thesis today, cheaply, in 48 hours or 30 days, without spending $5 million in 2 years building the entire complex API rail first, just to see if the market wants it?
The sources provide a highly specific, actionable validation signal for this exact thesis. It is a rigorous 30-day data test.
Walk me through the test. How do you prove this?
You don't write a single line of code. Instead, you manually pull the GST and filing histories of 50 specific SMEs over a 24-month period.
Okay, so you just do the grunt work.
Exactly. You meticulously calculate the financial penalties, the daily late fees, and the blocked input tax credits they suffered. You calculate that total friction as a direct percentage of their net profit.
I see how much it actually hurts.
Yes. Then you interview them to map out the root cause of those failures. Was it due to a lack of legal knowledge? Was it a broken internal process? Or was it a pure execution gap, like simply forgetting to hit submit on a Friday?
And what are we looking for in that historical data? What is the signal that we have a massive business opportunity?
If the financial drag of those entirely preventable penalties and late fees constitutes a material percentage of their profit, and the robust Zenodo study strongly suggests that it will be a massive drag, then you have your proof.
The evidence is right there in the math.
The market is demonstrably real. The pain is quantified in hard currency. And that specific operational choke point is highly monetizable. You do not need to guess if a founder will pay a subscription for a theoretical software solution.
No, you can just show them the numbers.
You can walk into their office, show them the spreadsheet, and show them exactly how much the invisible leak is currently costing them in lost profit, and offer to plug the hole.
It is so brutally empirical. You aren't pitching them software features. You aren't pitching them AI. You are pitching them the direct recovery of their own lost profits.
It's the ultimate value proposition.
Let's zoom out and summarize the incredible journey we have taken through these sources today. We started by grounding ourselves in the harsh reality of a resource-constrained founder. We looked at a business owner drowning in an ocean of 1,450 regulations, bleeding up to 17 lakhs a year, and trying desperately to manage 42 daily legal updates using a fragile, failing, memory-based system of spreadsheets and sticky notes.
We analyzed how the volatile regulatory environment structurally penalizes early-stage speed and acts as a protective shield for large incumbents. We defined the breaking point, backed by the stark statistical reality of the Zenodo study, where the compounding cost of compliance mathematically suppresses SME profitability.
We confronted the extreme, often hidden risks, the compounding interest of the GST trap, the terror of 486 imprisonment clauses, and the looming existential threat of the DPDP Act with its potential 250 crore fines. We dismantled the false profits, the shallow dashboards, and articulate AI chatbots that merely treat the visible symptoms while completely ignoring the underlying structural bottleneck.
And finally, we mapped out the architectural solution, the necessity of building a silent, deep compliance rail, an orchestration layer connecting banks, the GSTN, ledgers, and data privacy workflows. A system that makes compliance happen by default, structurally making failure harder, and ultimately capturing underwriting truth. The ultimate proprietary moat that turns messy, fragmented operational data into scalable, machine-readable trust.
For you, the listener, the takeaways from these sources are profound. Whether you are a startup founder desperately trying to scale your operations without going to jail, a software operator hunting for the next massive overlooked bottleneck to solve, or just someone deeply fascinated by systems thinking and incentive structures, the lesson is crystal clear.
Very clear.
The biggest, most lucrative opportunities in the world rarely look like flashy new consumer trends or sleek social apps. They almost always hide behind the most boring, agonizing, invisible administrative friction.
The most transformative technological breakthroughs are very often the quietest. They operate invisibly in the background.
And to leave you with one final, deeply provocative thought to mull over something drawn directly from the strategic notes we reviewed today, I want you to think about your own digital footprint at your company right now.
It's a scary thought experiment.
It is. Think about the myriad of apps and services you use every single day. If you were to join your single sign-on data, your team's expense reports, and your company browser logs from just this past week, how many random AI tools, experimental sauce apps, and browser extensions with deep, sensitive access to your operational data would appear that absolutely nobody in your company officially owns, monitors, or governs?
It is a chilling question, especially when you consider the severe penalties of the data protection acts we discussed.
Let that sink in when you think about where your own compliance leaks might be hiding right now. Because, as we have learned today, in the complex world of business operations, failure isn't always a spectacular, highly visible explosion. Sometimes the most dangerous threat is just a quiet, unknown leak in a system you simply forgot to check.
A muddy, silent, invisible drain.
Until next time, keep interrogating your systems and keep looking for the bottlenecks.